warm welcome to The Call. This is the program, 10 companies picked by you. We've got two fantastic expert guests in studio, and we will discuss these names over the next hour. It is Friday, the 7th of May. I'm Nadine Blaney. A big welcome to those of you watching on the live stream, of course. But also on board today, we have viewers on Twitter, Facebook, and YouTube. Great to have you along. We do this program every weekday at midday Eastern, and you can watch it live and on demand via our app or the website, or you can listen to it again as a podcast. I know a lot of our viewers do that just to get clarity on some of the calls that are made. We're very clear. On the day, it's a buy, it's a hold, or it's a sell. Now, here with me in studio today and with me for the next 60 minutes, I should say, Junpei Liu from Tribeca Investment Partners. You might get sick of me in 60 hours. And Adam Dawes from Shaw Partners.
Never get sick of you.
Come on, thank you. It's a Friday. We're feeling pretty good. Look, it was a busy week in terms of news flow. A lot of it coming from that Macquarie conference. Some upgrades coming. Were you surprised to the extent of some of these upgrades and guidance that we saw?
Yeah, well, look, we were actually surprised to the share price reaction to some of those upgrades and changes in updates to the market. Usually, the Macquarie conference years ago used to be known as the downgrade conference, when all the retailer one year had a really bad season and then they all downgraded. So it's been known as downgrade conference. And then since then, it's been known as tech conference. So because that's where all the international investors come in and see our tech companies present, and then they all, share price normally rally 30-50% since then. But this year is interesting because so far the consistent message out of the whole conference is that revenue is improving across most corporates. Revenue is improving, but cost is higher. Mm-hmm. So most of them talk to increase in material costs, increase in labor shortages. In a way that probably means that inflation will come soon. And then that we heard from all the retailers. What's interesting is that most of the retailer has presented pretty good numbers. Even though they've been the beneficiary of the COVID period, but still at the moment the revenue is not falling off as fast as some expected. So many actually had earnings upgrade, but the share price, none of them responded, because when the investor look ahead in the next 3-6 months, things is looking pretty tough for all of those retailers. So we're seeing from the e-commerce businesses being sold off, we're seeing the retailer, JB and other, Nick Scali and all of that.
Temple and Webster as
Temple and Webster being sold off. And so these businesses really struggled. And then combined with something else also happening offshore, you have all the growth, people selling growth company again and moving into value company. So all of those tech companies on the last day were all being sold off on the back of just US NASDAQ sort of falling.
And not only that, we had a chat with another guest earlier this morning pointing to US earnings season. We heard from PayPal overnight. They've got a basic product. It's called Pay in 4. It costs merchants nothing. We've seen a lot of pressure coming through on those buy now, pay later names, Afterpay in particular.
Yeah.
Has the tide changed in a meaningful way, do you think?
I think the tide has definitely turned, and I think it's always been the concern that margin from the merchant side is always going to be squeezed. Now, if PayPal come in and say it's not going to cost you anything, of course people are going to continue to go with that one as a merchant. The land grab has already happened in Australia and New Zealand, and they're even saying that in Australia and New Zealand it's a mature market. But the growth is certainly in the US, and that's where Afterpay and Zip are really moving towards. And I think that's what we've got to concentrate on, is those numbers in the US for that growth. And I still think that growth is still there.
So you are still a believer in the buy now, pay later listed?
Yes, for the better quality businesses out there,
Yeah,
definitely.
Anything from the Macquarie, so you agree? Sorry,
absolutely agree. Yeah, I think the US is a big market. PayPal talked about $1 billion transaction value, whereas Afterpay's got 5.7. Corpay is probably just under 1 billion. So but it's an enormous market, right? Penetration is really low, huge amount of opportunity. If anything, just demonstrate the demand for that kind of product.
But if I'm a merchant and I already have PayPal in my system and they're offering this for free, it's just essentially a different vertical.
Right.
inevitably will margins start to come under pressure for the Afterpays and Zips and QuadPays of the world?
Yeah, so two things. In the mature market, so say Australian being the mature market, they already have 10% penetration. So should the price start falling, because we've got Zip Pay, Afterpay, so many pays, right? And yet the price has yet to move. Mm-hmm. So that clearly shows there's a strength in the Afterpay or their model. Yep. But in the US, the penetration is so low. Where Afterpay and some of those guys is playing at the moment is on the enterprise level. So large retailers resellers. So these businesses, they're happy to have a couple of payment system. PayPal is not the key. PayPal, where it's big, is actually in the SME space. That small businesses end, and that's where Afterpay and Zip are yet to sort of breaking into. So honestly, it's an enormous market. There's a lot of demand.
Because this is the program that we're on, I will say, on this weakness, would you be buying into the likes of Afterpay or Zip, or would you just be comfortable holding now?
I'm holding, but look, I'm one of those investors who will buy on the dip. So, right now, Afterpay's moved from, $150, $160 down to $100, below 100, 197. So, it's a critical 200 moving day average, technically will tell you. But my view is that a good company like that, you just buy whenever it falls. Don't buy your full position, because we don't know when that rotation might happen, but that's nothing to do with Afterpay, it's everything to do with the market sentiment.
And Zip's on real good support levels here, I think 760, something like that, I think the price is today. If you look at the chart, there's actually a couple of spots where it's actually hit that level and bounced again, so there's some really good support there. I'm comfortable to buy Zip at these levels.
Thank you guys, and for the viewers, that I think you can consider your bonus conversation. I got a little bit off track there. It started with the Macquarie conference, but I did think it's a thematic that's come to the fore this week that needs to be talked about. It also brings me to the stock of the day, because of course the banks, the three big banks plus Macquarie reporting. We heard from Macquarie today, and it was a bumper results. I mean, double-digit bump in profits, massive $3.35 per share dividend, largely thanks to profits in the group's commodities arms, which benefited from a surge in electricity prices off the back of winter storms in the US. Net income, though, also up over 3%, despite a slight dip in assets under management. Now, looking ahead, the bank saying that it remains well placed for superior performance in the medium term, but is still maintaining a cautious stance with a conservative approach. Let's start with you, Jun Bei. It's hard to look past that $3.35 per share interim dividend if you compare it to what we've got from the big four. I mean, just yesterday, 60 cents from NAB pales in comparison.
Exactly. So look, dividends great, and also structural growth for this business is incredible. It's at a premium to other banks, but honestly, looking at the result, it's incredible. 12 months ago, so some people say, there's weakness because they're not giving guidance, very cautious stance. They are being conservative. 12 months ago, everyone expect earning to fall compared to the year before, because they had a bumper year the year before. They worry about commodity business and the like, and guess what? They grew 10%. So looking ahead, they said cautious. So everyone's sort of sitting in that flat line, sort of zero growth for next year. But I think Macquarie pull it through better than that.
It's really hard to argue with the numbers, and Shimaro Wickramoaki doing really, really well.
She's doing a fantastic job, and the market really likes her as well. So it's something that she's not getting any pushback when she stands up and talks. The market definitely listens. And obviously that annuity style business that these guys have got is just obviously paying dividends ridiculously. I think there was some issues around the Texan or North American power outage in Texas, and I thought that might have been a little bit of a pullback for these guys. But the balance sheet is well funded, surplus capital, dividends there. The banks were only paying out a dividend ratio of sort of 65%, which they're usually around 80%, so they're pulling back a little bit. But Macquarie's banking unit Tier 1 equity ratio of sort of 12.6%, that's pretty amazing and compared to what our big four are doing as well. So look, it's fantastic business. I think it's still in the portfolio. It should be still in the ausbiz portfolio, but it's going to be.
Yep, it is. Well,
it is. Yeah, it should be. Absolutely.
So I'm going to consider that a buy from you both. Now,
Buy.
the other thing that's a real thematic around the traps, Macquarie today saying that it is promising to be net zero by 2025, and its financing operations will comply to net zero by 2050. I mean, this is the bandwagon, isn't it?
Yeah, this is very important. Investors these days. So investors, or our investors and institutional investors, they all have a target by 2025 need to be net zero. So how many of the companies, say for investors, how many companies sitting in those non-net zero, and how are they going to reach there? If they don't reach there, how are you going to sell them out of your portfolio? So essentially, this is where everything's going. So everyone needs to reach there. It's actually quite interesting with that net zero zero a sort of statement because Macquarie has invested incredible amount of balance sheet in those renewables, but yet it's the target to meet those criteria is so stringent. It will take a few years to get there, but I think they're doing the right thing, and it's incredible.
So you are paying attention to that as an investor.
Yeah.
Do you get asked by your clients about
ESG is always every day. There's more and more, and with the Bloomberg screens, we can actually see how much carbon emissions companies have and where they rate and those kinds of things. I still get the question. I still ask the question, "Are you okay with this?" And a lot of people say, "Look, I'm still happy to invest in uranium or gambling and those kinds of things." But there is a huge subsect of people that are looking for a feel-good investment. The Hearts and Minds one has been a fantastic kind of stock that gives you that good feel.
That's right.
But that carbon net zero is going to be tough for these businesses, especially like the Coles and Woolworths of the world. They're massive energy producers or users of energy. They're really going to have to pull back. So is it a metric that we look at? Yes. Is it a final decision? Probably no at the moment.
So just be mindful that the trend, as you talked to before, is increasing in momentum, and every investor meeting that we attend has that. And this year is the first time every company that presented at the Macquarie conference had an ESG slide. Talk to the ESG, every single company. And this is, we've never seen that before. So certainly it's a spotlight.
Yeah, we had Oil Search's VP exec of sustainability, Beth White, on the channel yesterday. And, when a company like Oil Search is talking about sustainability, I think 20 times in the AGM and at the Macquarie conference, then you know that it's for real. Okay, so that is the stock of the day. Macquarie, it is in the portfolio. It will remain there, thanks to my expert guests today, Junbei Liu from Tribeca and Adam Dawes from Shaw and Partners. Should we get going? We'll get to the companies that have been nominated by you out there. Webjet is the first one on the list for Peter. He says Webjet is about to announce earnings on May the 19th. If the result is better than the market expects, will the share price jump due to its heavily short position? So is it a buy, hold, sell? When you consider share price, we've got COVID in Sydney, we've got the travel bubble suspended with New Zealand.
So obviously Webjet have started to and they've raised a lot of capital, and this is sort of what Peter's talked about, and I commend you, Peter, on your commentary in there, because it's fantastic, because it gives us a really good idea of what we need to sort of focus on. But they certainly have raised capital. They've converted some notes. They've done a lot over the time to shore up the balance sheet and make sure that liquidity and everything's there. The problem is that international travel today, I think I saw that they weren't going to be back for another 2 years, 2022 plus. So it's going to take time. Can Webjet then just do the domestic side? They have come out to the market and said, we think that we can maintain profitability. So maintain being the key word here, maintain profitability just on the domestic side. I struggle to see how they're going to be able to do that. This stock is very heavily shorted, and unless they come out with a really good announcement and get rid of all those or clear out those shorters, I think it's a sell. I just think that the reopening trade potentially has already taken its place, and now we're getting into reality, and that reality is that we're not going to see major amounts of travel going through into another couple of years. So for me, it's a sell.
And Flight Centre came out at the Macquarie conference this week saying it's expecting second half underlying losses to be broadly in line with the first half. Flight Centre was sold down. Webjet was sold down in tandem, in sympathy, I suppose you could say, and that was even pre, Sydney COVID outbreak and
that's right,
questions.
And the shutdown in the bubble. So I agree with Adam. I think these stocks are highly leveraged to the changes in expectations of reopening of the thing, because at the moment clearly they're not making any money. And Webjet has a big exposure to Europe as well, which cases have been far worse than what we experience here. So theoretically, if things does return, so when travel returns, this will be most leveraged because it's very cheap and it's heavily shorted. And if Europe return to that travel space, and there's a lot of cruise for these guys as well, they're exposed to that cruise space. So when people start, going on the ship again, this stock will do so much better than the rest of them. But right now, it's very speculative. Yes, the result is coming. Potentially, they could make a little bit less loss than expected. Highly shorted level means share price could jump on the day, but it will fade because you need a real earnings recovery. And so far around the world, we're not seeing that happening in terms of international travel. And another problem is we have now so many different variants of COVID. It's endemic. break. So I just don't know if the government's ready to completely open border for everyone to travel back to the pre-COVID level. It just seems like a very, very long recovery. Want to play travel, play Qantas. Much more. Actually, Qantas share price come off as well together with the whole basket.
Yeah, it did.
But Qantas make most of its money from domestic traveling, and we may have border shut here and there, but it's far better situation when you want to expect the future, international travel to return.
And there are lots of people traveling within Australia.
Yeah.
So that is a sell for you, Junbei?
That's a sell for me, yeah.
Okay. Let's get to the next company on the list. This is for Nick. This is Hutchinson Communications, HTA. Adam, I'm going to go to you first on this one.
Oh, yeah, right, okay.
Should I take that one?
You go, yeah.
I'll go first.
No. We discussed this earlier. Jubei's going to take
swap.
this one.
It's good to let me know.
That's right. Yeah. That's right. So this one, actually, I take this one because it's so easy. It's market cap 1.6 billion. It has very limited free flow. So it's 88% held by Hutchinson.
Yes.
And 10% held by 3G Telecom. And the only asset it has is 25% stake in TPG. So it's essentially I don't even know why it's listed. So to be honest, so it's listed. So essentially, it's a play on TPG share price. Now, TPG share price has gone through quite a few issues recently. The well-known the chairman, David Teo just announced the retirement. And then the CFO just left, and the share price just continued to go down. I think the TPG is actually looking very interesting. It's in a good environment at the moment, same as Telstra. Probably prefer Telstra a bit more. The mobile pricing is actually pretty good. Optus putting up prices. It's and the future growth is all about mobile for all these businesses. Once the competitive environment stabilizes, which seems to have been so, I think all these businesses in pretty good environments at this point. But TPG, because of the management changes, does worry people a little bit. But it's an opportunity.
But Hutchison Telecommunications, if you don't even know why it's listed, you would not be putting your money in
it. Certainly it's a void for me.
I'm just not even going to make you comment on it if you don't want to.
No, I'm in agreement 100% with Junbei.
Yeah. Okay. So that is if we're doing buy, hold, sell, we're just going to do it a sell on that one. So do you want to let me know which company you're taking over?
It's later on.
Okay, later on. All right, we'll talk about it in a bit. Austal is, last I checked, it was in a trading halt. ASB is the ticker code. It is for Mark. Look, he's saying great growth and stability, low debt, great contracts, and expansion around the world. Why is it so cheap? Is it a bargain? Is that how you see it, though? Do you see it as great contracts, great margins, expansion behind it?
Yeah, so take a step back. We saw sort of 3 months ago that the world was moving out of tech and moving into value. Now we've seen that value trade really rally up. I think now what we're seeing is that moving out of that value trade but into earnings, and markets are going to follow earnings. Is this deep value or earnings value starting to come through? Potentially, yes. These have some really good contracts. For me, though, it's a hold due to the fact that I really don't understand shipbuilding, and I don't really understand government contracts or naval contracts, those kinds of things. The NPAT increased by 4%, so I think it's better than expected earnings. However, they did temper expectations for the next for 2022 and 2023. So look, I think this one, I think there's a yield on this one as well. So look, a little bit of a yield. So look, it's okay. But I think there's better value elsewhere and better money spent elsewhere. So more opportunities, it's a hold for me.
A hold for you, but Junbei, we've just learned it's out of the trading halt. It has become a joint owner of a strategically important, we're being told, shipyard that is located around the South China Sea. Now we know that there's rising tensions around that region. It could be a beneficiary of increased geopolitical risk, if you want to put it that way.
Yeah, sure. You're right. This business has always previously, historically, been bought by increasing defense spend. So, it was a huge beneficiary in the last 10 years when US continued to increase their defense spend. In fact, they actually been given some cash from the defense department in US to build the shipyard. Now, the biggest problem of this company at the moment is last year they lost one of the biggest contracts, which is due to expire in 2024, and that's something like 30% of the earning. Now, they will need to fill that hole, and it's there's no certainty of how they're going to do that. If they can't fill up the shipyard, the cost just incredible in that space. So just matter of knowing how that earnings is going to be filled at this point, and we don't know. We have no visibility of when the next contract is coming. They won a couple of small ones, just not big enough to really cover that very lucrative contract. Usually for this business, when you first make a ship and then you sell a couple of ships, the margin is very low because the cost of building the first ship is very expensive. But then if you keep making the same one, then the margin goes higher and higher because you don't need to innovate and do the same thing. So by losing a contract that's been going on for a long time, which is very high margin, and filling with a new contract, even if you get one to fill that space, your margin will be very low to start with. It takes a couple of years to get to that high margin. Right. So that's the challenge for the business.
Yeah. So that would be a hold for you or a sell?
Oh, it's a void for me.
A void. Okay. Yeah. That's Austal. Let's get to the next one on our list. This is for Ricky. It's Maca. MLD is the ticker code. I had to look this one up. It is in the contracting space.
Yep.
Sort of mining services, but concrete and a whole bunch of things around that sort of industry. Yep. Do you know the company?
Yeah, certainly. It's actually one of the, if you could say better, there's Fleetwood, Maca. There's a couple of decent businesses inside of these mining services area. The issue that we have, and Junbei touched on it a little bit before, is wage pressure or wage growth going into the mining sector. Because we now can't fly people in from overseas to work the mines or to drive the trucks or to do the mining services side of things, wages are increasing. And you can pretty much in WA can ask, and you can basically get as much as money as you need when you're asking for these things or getting some jobs. So I think the outlook for Maca is actually quite good because obviously they are a mining services business, but the problem is, and I see that cost of work or the cost of employment is going to rise, and hence margins are going to fall. Yes,
and margins are already quite tight in this area.
It's very
anyways.
Tight. That's right. So I think, look, I agree. I think the company is very cheap. It's trading on 2 times EBITDA, really cheap. But it's just that inflation, we don't know how much they can recover. But one thing, I guess, for Maca is most of their they contract mining, right? So that there is some protection in terms of wage inflation, but not all. So margin will be under more pressure, and arguably it's a bit too cheap.
And I think if they stay with that fixed price contracting, there's always a chance that things are going to slow down. There's going to be a slip up, and then your profit is lost straight away. So it's a tough one. I think they're very upbeat on their outlook and their commentary to the market. They're very upbeat, but I like Fleetwood is probably my stance on this one. So it's a hold from me. I prefer Fleetwood.
Okay.
Probably a void for me. I much prefer larger. Contract mining is, look, the mining services businesses are very, very tough. Much rather to be in the bigger names like Seven Group and others, right? So give you more leverage to the recovery in the mining spend rather than the smaller one like this, even though it's very cheap, probably something to watch.
All right. Ricky, that one was for you. Let's get to, another sort of related name, I think. CDA Codan is the ticker code in the gold mining services space in a roundabout way. This is for Patrick. Thanks for writing in, Patrick. This is one that people often say is the one that got away.
Yeah, and still continuing to get away.
So considering its price, is it too late to jump on the bandwagon?
Most brokers, and I think I saw on the screen today, brokers have upgraded it closer to $17. I think it's around $17 at the $17 at the moment. So it's probably fair value here. But communications is a critical need, is a critical issue for any businesses in the mining services space. And they just came out and bought out a business called Zetron, which is a US-based provider of mission-critical communication systems for rural and metro agencies. So I think that is going to lift the earnings of this business, and they acquired it for $45 million. So it's definitely at an attractive multiple on 2020 multiples. So I think this is a buy. I've already missed a lot of it, but reading into it, there's a number of growth opportunities and synergies that they can make attractive, and that's basically gaining market share in a very large market in the US. So I think there won't be much on the earnings impact, and in fact, at $17, sort of under $17, I think it's a buy. I'm going to go out on a limb and say you should pick some up.
Yeah, so I think that was Macquarie. I read the same note talking about even the potential for additional revenue synergies from further acquisitions. So do you see growth?
Absolutely. Yeah, absolutely. I'm a shareholder and I would buy it today. I think it's in the right place at the right time. So, there's an incredible amount of demand for all this underground communication.
Yep.
It's metal detecting business done incredibly well. And, it's earnings being upgraded steadily over the last little while. So, and then with the acquisition opportunity, I think it's well positioned. It is more expensive than the rest of the market, but because it's delivering good growth and it makes good real earnings, right? So it's a bit different.
And this is the thing, is we talk a lot about price and valuation, but you don't mind paying for quality, right?
You don't mind paying for quality, and especially if it delivers growth that's underpinned by its driver, that's not just because world is getting better.
And earnings are moving in the right direction.
That's right.
So earnings follow, or share price follows earnings.
Yes.
And if earnings are moving forward, the share price, and everybody will be happy to keep buying it until that stage where earnings don't.
Yeah.
Pretty incredible chart on screen there, and it's releasing a new GPX 6000 metal detector. I looked it up online just because I think it's interesting. So that's Codan, and it is going into the Ausbiz portfolio. Hard to believe, but that brings us to the halfway mark already. So if you are watching for the first time, what we usually do around this mark is just summarize what we've learned so far. I'll do it pretty quickly. With Macquarie, which is the stock of the day, released a bumper result today. It is a buy from both of my guests. It's already in the portfolio, and I'll walk you through the portfolio if you're new to the program in just a moment. But look, they don't really have anything negative to say about Macquarie. And if you're a shareholder, that $3.35 per share dividend that you'll be seeing in the wake of the results today, congratulations on that. Webjet was the first on the list from our viewers. It is a sell from both of my guests. It doesn't really matter at this point whether or not we see some borders, travel bubbles. It's just got a lot of unknowns still around it. It really needs to, have that reopening actually come to fruition before we'll see anything meaningful. It's very leveraged, it's very specky in June Bay's opinion. If you are looking for that reopening thematic in the travel space, she would prefer Qantas. Hutchison Telecommunications, this is going to be short because June Bay doesn't even really know why this company is listed, so why would you put your money there? Sorry, Nick, if you were hoping to, and it's a firm sell from Adam as well. Austal, it's a difficult one because for Adam, he doesn't really understand in detail how these defense contracts come about. So for that reason, he would not be looking to get into it, even though it does look like it's got some good value. It's a hold for him. It's an avoid, though, for June Bay. It's got this big contract hole that we still don't know how it's going to fill. So that's enough of a reason for her to just avoid this one. Maca both said that it's a pretty good business in the mining services space, but for June Bay, avoid it. Even though it looks cheap, it's a difficult area of the market to make money in. Fleetwood is Adam's preferred pick in the mining services space because it all comes down to sort of margin pressure when you're talking about these mining services companies that work on contracts as well. Codan is going in the portfolio. So this is a question from Patrick CDA. It's a buy. Both see growth opportunities on the horizon. Quality business. They're not scared by the current price because there is the opportunity for further growth. June Bay owns it. She would buy it today. So that brings us to the portfolio. So we are running a portfolio. We call it ours. It's the call. It's done in conjunction with our partner at NabTrade. Thanks to the guys there. We've been tracking this portfolio since July 1st of last year. So the rule is any companies that get a 2 thumbs up or a buy, it has to be from both of the experts on the show on the day we've been putting into the portfolio. So here's how we're looking today. So for the week, down by close to 2%, over the month up by close to 1 3/4%, and year to date we're up by 28.6%. Some of it is thanks to my guests in studio today. Lately we have added Silver Lake Resources, that was just yesterday, Virgin Money UK.
Who did Virgin?
Well, it's funny. That was the same reaction from my panel yesterday, saying, "Whoa, that's a big call."
I'm pragmatic on the Virgin. I think it's okay.
Really?
Yeah, it's okay. Yeah. Banks. UK, it's getting better.
Is it going?
They actually released results this week.
It was a good result.
Was it? Okay.
Maybe you should go read it.
Well, maybe I should.
Stars
It's very speculative.
Yes.
It's very speculative.
At Reliance Worldwide, again, we heard from them at the Macquarie conference. There's that price pressure that was talked about. They are confident they can pass those prices on to their customers, and it comes in a week that copper hit, $10,000 plus this week. Beach Energy as well. I asked the question yesterday. I would presume it was put in ahead of that announcement last week, which was a big downgrade. Big questions.
Yeah, look, I think it's a little bit too speculative here, because they downgrade, even though that reserve itself is only now 16% to overall reserve. But some of the reasons for the downgrade, shrinking that reserve by 30%, is they said, they drilled the hole too close together and create some issues. But then people ask, well, why do you drill too close together? Does that mean you're trying to, you overinflated your potential reserve and, all of that? Then it just poses a question about everything else. Have you applied the same assumption for every other reserve?
Yeah, I remember it I think it was this time last week, saying that there was an urgent review now going on across there. I mean, that's not what you want to hear as a shareholder.
Not at all, and the share price has definitely been beaten up on the back of it. And our analyst has now moved to a sell on Beach. He said that he can't trust management, and
that's a problem.
That issue going forward can be quite systemic in the business. So, I mean, look, Santos potentially, Woodside, yes. There's plenty of other ones that you could look at. Oil Search, I'm a bit scared of at the moment as well. So, but that oil price isn't really budging. It's sort of $62, $65. It's not really budging that much. We saw Aramco the other day came out with their oil price of $62 is their break even. So anything under 62, I think you see the oil price starting to move higher, because obviously Aramco is OPEC, so they're going to maintain that sort of level of 65. Obviously they want it to go higher, but it's a good sort of level at 62 where you think there might be some value if it does start to fall back around to that 55 mark.
All right, if you'd like to know what else we have in the portfolio, you can do so by heading to ausbiz.co/portfolio. Let's get going on the remainder of this companies on our list today. This one's taking it from a little bit of a different tack, and it's interesting because obviously these guys both sort of active managers, Juve in particular, but I love the question that's been posed from Mike. He says, I have a new grandson born on the 27th of March, and I would like to put some money aside, potentially in Earth ETF. So this is the BetaShares Climate Change Innovation ETF for him. I'd welcome the panel's view. This is anticipated to be a long-term investment. Perhaps, we could continue to add to it over the next 18 years. So great sentiment. Congratulations on the birth of your new grandson, Mike. I'll start with you, Adam.
Yeah, I wish I had a grandfather like Mike, giving me good stocks and good ETFs inside of a portfolio over the 18 years. Look, I think Earth is a fantastic business. I think it's something that you can continue to add to over time. We all talk about ESG. It's always there. It's part of it. This fits that thematic just perfectly. Basically, what happens is that they have to have derive 50% of their revenue from green revenue. So being revenue associated with green energy, green transport, waste, decarbonisation and sustainable products. So a lot of it is actually quite US centric, as far as that the United States makes up to 42% of the portfolio. So you need to be a little bit careful of what's going on there. China 11%, and then it goes down. So you are getting a great exposure to the US. Some of the companies that are in the US, obviously Tesla, which looks really quite interesting, Zoom, DocuSign, those kinds of businesses. I think they're all sort of new age as well as whatnot. I use this for my portfolio for clients that need international exposure, but I also use FAIR, F-A-I-R, for the Australian component of the ESG or green theme. So I have Earth for international and FAIR for the domestic side, and clients really love it, and it's really performed quite well.
So yeah, because it does come down to performance as well.
Absolutely, it's
so
performed
you would
very
put it
well.
in these, clear conscience, 18 years,
Absolutely.
and still looking for.
Yep, and you get a nice feel good.
Who doesn't like to feel
Well,
good?
who doesn't?
Especially on a Friday.
That's exactly right. Feel good Friday.
I mean, if it is complicated to invest in ESG, considering the difficulty it is in knowing exactly what companies are doing, what metrics they're having to report against, et cetera, is this a fair way to gain exposure to the thematic?
Yeah, so my view is that if you don't have all the time looking at the companies, finding the best company to invest in, they have all the time to monitor that. ETF is always the best way for retail investors, and especially ETF with that green exposure. I think Adam's gone through detail about how what this split and all of that. But I think, just given the amount of interest and flow we've seen going into ETF that has that whole green exposure or ESG exposure, it's incredible. It's 50% of all the flow in the US, and it's growing. So it's enormous. So I think it's a good thing to play.
Okay, it's a sound investment for your grandson. All right, let's get to the next company. This is for Vince, Medibank. Again, I feel like I'm doing Macquarie's advertising for it, but a lot came out of the conference. Medibank was out there upgrading policy growth target for the third time in FY21.
Yeah, that's actually very interesting. The whole sector has, the health insurance sector went through, a few years of terrible growth in terms of, insurance from individuals, simply because people couldn't see value. Your out-of-pocket cost is still too high and all that. But because of COVID, now we suddenly actually started seeing the growth in increased policyholders. So people are more health conscious, which is very, very interesting. So for the first time, we're actually seeing the industry perhaps is not so doomed, because previously we thought that whole system is not going to stay afloat. But so if the growth maintains and people continue to be more healthy, that is very positive for the top line for those businesses. Now, but there's one thing going against them, going for them at the moment and in the last 12 months, is that people haven't gone to the hospital because the hospital was shut. So there's not that much claim. So they've been sitting on all those unclaimed reserves. So these businesses will literally just write back some of those claims to manufacturer earning, or has been doing so in the last 12 months and next 6 months perhaps. But when hospital reopen, when we return to the normal level of surgeries and things, that claim will pick up. It's just a matter of time.
It's an interesting one. So will the claims pick up and then that demand all be brought forward, or will it just go back to normal? It's hard to sort of know if everybody's going to go out and get all these surgeries or glasses or dental work that they needed to do, or if that demand is sort of waned.
Yeah, so look, certainly if we look at, obviously it's harder to see, taking 2 years view, but we have seen the backlog for the hospital system is very high. For the private hospital system is very, very high. So it just actually matter of working through those backlog for the private hospital like Ramsay and also public system, because people couldn't go to surgery before. Now it's all been scheduled on. So things are coming back in a big way. So next 12 months, this is a bit like retailers 6 months ago. So in the next 6 months or 12 months, earnings going to reverse the other way. And also what's interesting for these businesses is that Medibank actually quite smart, that it is very highly politically sensitive to be viewed that you profit from the COVID. So Medibank actually spending back into, even though they didn't spend anything on the claim, but they spending back for the members, lower fee increase and all of that. Whereas NIB did the opposite. They did actually try to increase the profit. So the upgrade was actually quite large quite recently. So, going forward, we do see that normalizing, because you cannot profit from a pandemic like this. And then in time, you will have to pay back into the member to increase, fee lower, to make a lower fees for your members.
So net, if we're healthier, but there's also backlog to do. I mean, do you like the short-term outlook for Medibank? Would you be buying it?
I think it's a hold for me.
Okay.
It provides a good dividend at this point. And as I talked to, they're holding on to a lot of profits, a lot of cash flow. So it's actually really good for Medibank at this point of the cycle. But in 6 months, I think share price, it will really struggle to go higher because of the earnings reversion.
So you look at that chart and you look at it at $3, 307. It's hit there 3 times now, and for the last 2 times it's failed. So you've got to be a little bit careful here that if it does fail from here, if it's back down to $2.68, $2.50, and then probably, yes, you can look at this again. I'd be cautious here. It's a hold from me just on price action, but also it talks about claims catch up and deferred claims liability. So both of those are going to, and basically Macquarie saying in their note that they're saying that relief costs are going to go through for first half of 2021, but expected to reverse in the second half of 2021. So exactly what Jumbo is saying, that you're going to see this massive influx of profitability or movement through those policies, but then that's going to reverse in the second half of the end of 2021. So look, for me, it's a hold on the price valuation alone. I think it's good, but it's going to be tough. The other thing about this one is that millennials don't see health insurance as important.
Well, It's also
thing.
expensive.
It's
for
also
millennials,
very
you know,
expensive.
not just for millennials.
And so they're
sometimes
probably
for
happy to
everybody.
take that 1% tax. You know, there's a
Yeah.
you get a fine or
Surcharge if you're making above a certain amount
right.
of money.
So you know they have to change the way people think about health insurance because we've grown up with it. I guess these guys are saying, well, we don't really need it. So I think there's a big visual is not the right word. They need perception of the industry, and they have to change that.
Yeah, well, I think they're trying. And the other thing is that it's subject to regulation. I mean, policy as well.
100%.
And there's something. This is one to watch around the federal budget. They're looking for reforms on prosthesis. If that does not come in this federal budget, then it will potentially come later in the year. But just to the point that it's also subject to regulatory concerns. Okay, so that is Medibank. Let's get to Antiotec. So it is. This is yours.
This is mine.
Over to you, ADO.
Just like that, hey?
Just like that.
Oh my
COVID-19
goodness. All
rapid
right.
test.
There you go. So yeah, first of all, on a technical side, ADO put out a share purchase plan. They raised up to 12 million through the issue of 46 million shares at a price of 26 cents. So if you look at the share price today and you're a shareholder and you've got the SPP in front of you, I would take that up, because at 26 cents a share versus where it is at 33 cents a share, I think there's some value there to happen. However, what generally does happen with these kinds of stories is that once the share price has a level, but then the SPP is rolled through, you will see the share price come back to around about that 26 cent level. So there's be a little bit cautious of putting too much into this, but certainly it's done at a deep discount. Obviously, the funds are going to be placed to scale up the roll-up of the Eugene reader and the in vitro rapid diagnostic test for the detection of SARS or COVID virus. So, look, it's an interesting one. I'd buy it in the share placement, so you're a shareholder, I'd do that. I don't know if I would then continue to be investing this thing after, because yes, these rapid tests for COVID is going to be interesting, but is it going to last? And is there another test that will potentially come out and get these guys off the pedestal? So for me, I think it's looking good at these levels, but I'd be cautious, and I'd probably be buying it. If you don't own the share, I'd probably be buying it around that 26, 27 mark, because most stocks will come back to that SPP price as a level and then start to move from there. So you could plan your entry point a little bit lower where it is. For me, it's a hold. I still think that this whole diagnostic side of things, there's going to be a better solution to it coming up. So it's a hold from me.
Is it too specky for you?
It's actually interesting whether it's it is speculative, but we've seen in the last, this is a great thing about capitalism, in the last 12 months or 18 months, we've seen incredible amount of new business model that pop up that actually completely leverage to stand to benefit from what's happening in the world, and this is one of them, and we've seen a couple of others that listed. They all done incredibly well during this period, and presumably we will do still okay for the next 6 months, given things are still recovering very slowly around the world. So there's a bit more money to be made. But the question is, do they really have a business model when the world return to normal? We know it will, and perhaps it's 12 months or 18 months away. So that is the question. So I don't know if this business would have been around if we didn't have this. So yes, there will be increased demand for testing for all of those, but by a testing business, by Helios, by Sonic, by these businesses, because they've proven they got so much cash, because they made so much cash during this period. They're on the acquisition trail and all of that. By those quality businesses, this one is just it's very speculative. We don't know what it looks like in a year's time in terms of earnings. Very hard to make the call.
Okay. Eclipse Group is the next on the list. This is for you, Alex. I hope you're watching or listening for this one. The first half result came out just yesterday, I believe, the day before. Things were looking really good. So, the order pipeline is strong, new tender wins. Things seem to be going really well, but a question is, I suppose, is it as good as it gets?
Well, potentially yes, because the end of lease or that sort of novating lease or those kinds of things that this business does certainly could normalise in the next 6 to 12 months. So I'd be cautious about that. I think these guys owned Grays Online.
They sold it.
So they sold it. So they definitely sidestepped or sidestep a bullet on that one because Grace Online potentially tried to come back out and relist the game from private equity, and it didn't get any showing at all.
I actually forgot what happened.
We were on the we're on the ticket or trying to get it away, and it just didn't get away. So I think this Eclipse group is one of those ones that is a strong leasing business. I feel that the share price is tracking quite well through 2021, but I prefer, so it's a hold from me because at end of year, or this leasing business, one can get, I think Macmillan Shakespeare, right. we can see that one stroke of a pen and a business has disappeared, but also then new cars and are still going really strong. And our next stock is probably where I'm a little bit more excited about. So I will hold off on giving anything more.
We're all about building the excitement here.
Well, that's what I was trying to do.
Yeah,
so this one is a hold for me. I think you could find better value elsewhere.
Better value elsewhere. So Eclipse, some strong car leasing demand. It appears as if this is a really well-run business. Does this area of the market, though, need some further consolidation?
Oh, absolutely. I think this is probably the most exciting part about this industry, the consolidation. We've seen some recent announcements, and this one, presumably in the next 12 months, could be taken out and the like. And now, the business had a few tough years when they bought all these businesses, Grace Online and things, and it didn't work out. And so the management team came in, delevered the balance sheet, sold those businesses, just clear the deck, really cleared everything, and so the business seems to be going a little bit better. Now, what's happening now is because of which next stock we'll talk to is the car sales market, the used car sales market is very, very strong, and that generally, translate into the car lease industry as well, because there's a lot of demand for it.
Yep.
So they're in a good spot at the moment, and it's not expensive. It's probably 10, 12 times. So for me to hold, because I agree, there's a lot of regulatory risks. The government has talked about reviewing it to, close that loophole, but it could come anytime. It could come next year or whenever. Yep. So that's a very big earnings risk. And but the consolidation perhaps is something that you will see in this industry because the bigger does get more scale benefits.
Mm-hmm. Okay, so Eclipse is a hold from both of our guests. I know you just want to talk about the next one, so let's just get there. Autosport, ASG for Leon. So I'm feeling the vibes coming from you. You really like this one.
Well, look, I like the way that the market has moved over the last 6 months, and we all thought, okay, cost control, you can't get enough cars, so basically, they're gonna struggle. These businesses have gone from strength to strength. AP Eagers, this one, and there's another one in there as
Peter
well.
Warren, the
new one that's come on has done very, very well. So I think those are going to be favourable trading conditions for the next 6 to even 12 months because they delivered a really good, strong growth. Their top line data, they came through profit before tax at 29 million. That was at a 164% increase on prior corresponding period. And if you look at the chart, it really does look like it's just moving up really nicely. And AP Eagers has also done very, very well. So they've got to what they've got to do is keep those costs lower and basically move to make sure that those margins going into 2022 may improve. So I think this one, I'm going to go out on a limb. I've the 2 limbs today, but I'm going to go out on a limb and say it's a buy because I still see the favourable new car market coming through in the next 6 to 12 months isn't going to stop, as well as the used car market is still very, very hot.
So Autosport Group essentially sells used cars.
Yep.
But what makes it different than a carsales.com?
Well, they get a better margin.
Okay.
They'll make $2,000, $5,000 a car, and they can continue to turn them over really, really well. Car sales just takes a clip on the overall fee, and these guys will use car sales to get the people into the showroom to do that. So I think they sort of coexist quite nicely going forward.
Car sales is pretty much just the advertising.
Classified.
Classified.
Right.
It's a classifieds, online classifieds, whereas the other one is actual dealership. So Autosport exactly in the right spots. It's interesting. Autosport almost feel like probably 6 and 12 months ago of the retailers. Because things are going so well. The reason it's going well is because because of all these COVID-related shutdown, all the cars are not being manufactured. So cars out of Japan and things. There's no new cars.
Yep.
So that made the demand for the, especially people driving more as well, made the demand for the second-hand car. So, and what's interesting normally with the car dealership space is that top line growth normally is very slow. It's like a population growth, few percent, and then the margin is normally reasonably thin. But what's happening now is because there's no new car coming in and second-hand car, so you increase the volume demand for the second-hand car and the margin. There's no discount anywhere. If you want to get a car, there's no discount.
Yeah,
so the margin to those dealers is incredible.
Yeah.
So this margin is not sustainable, but for the next 12 months, it looks like for at least 10 months, there's no new cars coming. Yeah. So it's good for this time period, but just be mindful. Remember the retailers, now it's all been sold off 30%, even though the earnings still all-time high. So you just got to time yourself as you get closer to that day.
You would not be buying today?
I'll be a holder of this company, but I know that day is coming, probably 3 months away.
Yeah, and then you add semiconductor chip shortages on top of it, and this could be probably a little bit longer of a thematic potentially than we had thought. Well, that brings us to the end of this part of the session. I forgot a little bit earlier on to talk about the buy now, pay later names here in Australia. So the listed Australian names, Afterpay, Zip, both of my expert guests today, June Bailu from Tribeca and Adam Dawes from Shaw & Partners, are still quite positive on that part of the market. So just thought I'd put that out there. Let's reiterate what we've learned. BetaShares Climate Change Innovation ETF Earth. This is for a long-term hold, and Adam's quite happy with this. He thinks it's a good one. I think it's a buy, and it was a buy from June Bay as well for the reasons that were stated. It's long-term ESG that will be going into the ausbiz portfolio. So Medibank is also on the list. This one is for Vince. Things are looking quite good now, Vince, but June Bay questions how long that will continue when you start to see this backlog of demand being placed on the services. It's pretty good for a dividend. It's a hold for her. It is a hold for Adam Dawes on the price action alone. Take a look at the chart, what levels it's bumping up against and where it could potentially fall to. Antiotec, ADO. This is a hold. I think we got there in the end.
Yeah, it was a hold
for Adam.
Definitely.
But if you are already a holder and you have the SPP in front of you, it is a buy.
Yeah.
But keeping in mind, it could fall back down to that 26-cent level. If it does fall, this is complicated.
No,
it's
not.
26 cent
what
level,
I do every day.
Then Adam would buy the company. Okay, so it's not one that you may would be interested in because it is specky. It is a narrative that only came about because of COVID. Will this company exist once we get back to normal? Fingers crossed. Eclipse Group is a hold from both of my guests. Consolidation in the sector is probably the biggest plus for June Bay. Just a hold for you?
Yeah, it's government.
Yeah.
There could be a stroke of the pen.
There could be a regulatory change.
Yeah.
Autosport, though, Adam could barely contain himself. He wanted to talk about this one right at the beginning. It is a buy. He's going out on a limb, but he really does like the narrative that's taking place right now. Junbei says, things are looking good right now. It's a hold for her, but keep in mind the margins are not sustainable. Again, while we're not getting any cars now, used cars are hard to come by. The margins are looking good. Again, it's a story that it's got the clock ticking on it even as we speak. So that was all the 10 stocks nominated by our guests. Macquarie Group was the stock of the day. We heard from the three big banks. I think it would be remiss at the end of the week not to ask about that.
Yeah.
Are you a buyer of the big banks? Are you a comfortable holder?
I think I'm a comfortable holder to slightly buyer. Look, a comfortable holder probably is where I am. The result they released, all pretty good, a little bit better than expected. Economy is recovering. They got all these provision they can release, and capital ratio looks good, and dividend is marching its way up. So by the full year, we should see a little bit more. And the large bank like CBA probably likely to have more capital return, probably a few $1 billion that will be announced. So I think they look pretty good. I prefer Macquarie, of course, but the rest of it, they don't look that expensive. With the economy improving, I think they're good. Well positioned.
Do you underweight?
No, I did a lot of buying last week.
In anticipation?
Pre these results.
You were rewarded with Westpac, but not necessarily with the other two.
And that was my best and favourite story. I thought Westpac absolutely hit it out of the park. They got rid of all of their fines. They've got rid of all of the bad stuff. They're pushing that aside. They're now moving forward. It was a cracker of a result. Though I did buy the whole sector for most clients. I topped up most of the banks. I feel that the banks have definitely turned a corner. The value is still there, I think, a little bit left there, but we're buying it for the income. Yes, the payout ratio has come back a little bit, so back from 80% down to sort of 60, 65. ANZ flagged that a while ago. They flagged that a couple of 6 months ago that payout ratio was going to come down. But as Jumbo said, that second half dividend is going to be a cracker. So this first one came through, it was a little bit better than previous, most people thought. I think the next half dividend is going to be really, really good, and that's going to keep that full year dividend nice and tight for the banks. And I think there's still good value there. So yeah, I've been buying them.
Spoke with Ross McEwen from NAB yesterday, and he said they are targeting between 65 and 75%, but not ruling out the potential for buybacks. Of course, if they're very cashed up, and
I think CBA is definitely in the box seat to
probably
do that first.
About $2 billion, one or two, probably $2 billion.
So that's going to be great for shareholders as such. But really, the banks have turned a corner. And you just see that it was 6 months ago, you started to see the little green shoots starting to happen and the regulatory issues coming away. It's definitely a good one for those income style clients, and we've got lots of income clients that need that extra income, and that's what's supporting the share price at the moment.
All right, guys, I could sit and talk all day, but I know you've got to get back to business. Thank you so much for joining us. Jim Bailey from Tribeca Investment Partners,
Thank you very much.
Adam Dawes from Shawn Partners. Always great on a Friday. And that's our show for the day. If there are any companies that you would like us to cover, please flick us an email, thecall@ausbiz.com.au, or you can tweet to us at AusbizTV if you've been watching us via the live stream, YouTube, Facebook, Twitter, or via the app. Thanks for joining us. We'll be back after this very short break.
One of those episodes you watch 3 times and every time you hear something new.